Good morning, everybody, and thank you for joining us today on our investment CPE class. We think we've got a really good session for you today. I think you're going to enjoy it. I'll start by saying I hope a few of you picked up on the clever play on words I did with the title of the class, being we think today's class content for you all will be high yield. And of course, that's a little bit of investment terminology there as well, being high yield investment class. So I thought that was quite whimsical. My wife corrected me. So we've already learned something today, and that is that auditors are not funny, and I should listen to my wife when she tells me that I'm not being funny or clever. But just continuing with the investment puns, we do hope that we pique your interest with our content today, but I promise that will be my last investment pun for the day, because you're probably I think I've already seen a few participants leave after those two puns. But no, really excited to have everyone here today, particularly as we're doing something a little different today. Many of you will have been on CRI's governmental specialist training sessions before, but normally it's all CRI speakers. Today, we're teaming up with public trust advisors who are investment specialists. I don't think, we all get a lot of GASB heavy training sessions. We wanted to try and deviate from that. We've got a bit of GASB, obviously. We've got the second half of the session is going to cover the investment specific GASBs, but we've got some real investment specialists here today that can give a different sort of area of expertise and information that they can provide from being investment specialists who work solely with governments, I believe. So they're really niche in this area. They offer a bunch of things like back office technology and distribution and marketing support, as well as investment strategies. So if you've got any questions for these guys, please pop it into the Q&A, or even if it's questions on GASB, any questions you have at all, please pop it into the Q&A. We will try and have time left at the end for some questions. If we don't have time, we will address them directly with whoever submits the question after the fact, or we might even address and give our response in the Q&A box if we don't do it verbally over the presentation. So really great team today. I'll get into the slides and we'll start moving through the slides right now. So we'll go to the next slide here, and then I'll do the intros of who's speaking with you. So I have the next slide. Oh, actually, let's just jump back. So before we get into the presenters, sorry, I almost skipped over the admin stuff. Today's session is for 2 hours of CPE credit. You do need to be logged in with your own unique login to get your own CPE credit. There's going to be polling questions. There's going to be 12 polling questions in the session today, and you must answer 80% of the polling questions to receive your CPE credit. You do not need to get them correct. You just need to submit an answer to 80% of the 12 in order to get your credit. Our team, who work extremely hard setting this up and do a great job on these sessions, they will send out the certificates typically within 7 days of the webinar. So look out for those via email. And there's you'll see on the screen there the email address that they will come from. And if you do have any questions around the CPE certificate process, you can see there our marketing team's email, and you can contact them regarding your certificates if you need them. But like I say, usually wait 7 days from today, and you should have received it via email. So that then the final comment on the screen there, that you can get a PDF handout of the slides today. That's available through the Zoom chat download. So if you need those, you can download those. Next slide then for me, and I'll get we'll get into the presenters, and then the first one from CRI, Alan Bowers. If you've been on our presentations before, and our governmental CPE sessions before, you may have a good chance you may have heard Alan's present before. He's an expert. He's a governmental partner in Albuquerque, and he's going to be covering some of the GASB content today, and he's going to do a really great job. So I think most people are probably familiar with it, AJ or Alan Bowers. So I know you'll enjoy hearing him speak today. Next up, we have Dean Mead. Now, I am super excited to be introducing Dean. I can't hide it. Dean has just joined CRI, and he has incredible governmental experience. Not that I'm putting too much pressure on him here from the beginning, because he's just joined us recently, but he actually spent 24 years working with the GASB. Very, very, very experienced on technical matters as it relates to GASB. So another thing that'll be a little different in today's presentation, which we hope you'll all enjoy, is AJ is going to present the GASB standards, and Dean's going to be able to provide some kind of some commentary, from a perspective of the GASB who wrote the standards, and I think that's going to be really interesting perspectives and insights that Dean can provide there. So he's going to be presenting from CRI as well today. In addition, we got one more presenter slide next, and this is Rodrigo. Rod is a fantastic presenter. I've really enjoyed working with him in preparation for this session, and he's from Public Trust Advisors. He's actually based in Florida, but he also covers California as well with his investment expertise, and he's going to be presenting the first half of today's session, covering a lot of the investment specific technical stuff that the auditors aren't quite as experts at. So those are our prescribed presenters. There's one other presenter who's with us here today, also from Public Trust Advisors. Oh, that's me as well. I've got to introduce myself. So I'm Robert Lemon. I'm a partner with CRI, and I'm just moderating today. So you'll hear me do the polling questions and the intro and the outro. But that's my role. I'm a governmental partner in Albuquerque, just like AJ. So again, I think if you've been on these governmental CPEs before, you've definitely heard from me. And I was mentioning that there's one other person with us today, Ash Mehta. He is from Public Trust Advisors. He's not got a prescribed speaking role, but he'll be on to address questions if needed. He's an investment specialist out of Arizona. So yeah, we got a really great team, big team of people with us today. We'll move on to the next slide. I think that's it for the intros. Yep. So great team presenting today. Here's what we're going to cover. As I kind of mentioned earlier, Rod will lead the first half, and that's going to be items 1 and 2. So item 1 is investment options, an overview. He's going to cover a whole range of things here: bonds, treasury bills, agency securities, and there's a section on CDs, repurchase agreements, and commercial paper. And then finally, a section on mutual funds and investment pools as well. So a whole range of investment options going to be covered. And then Rod's also going to give us some economic outlook as well, and cover a section there. So I think some really interesting stuff that's going to be covered. Then we'll switch gears on the second half for AJ and Dean to run through the GASB standards that apply to investments. So that's going to cover GASB 3, 40, 72, and 79. So some really old stuff to some really recent stuff. And I think it's going to be a really great session. So with that, we're going to get into it. I'm going to hand things over to Rod, and he's going to take it away. So over to you, Rod.
Thank you so much, Rob. And I just want to take a quick moment to thank the fine team at CRI. It's really been brilliant working with you guys. I've enjoyed the process, and both myself and my colleague Ash, who you were kind enough to acknowledge, truly appreciate this opportunity. And yeah, we really look forward to it. So thank you for that. And by the way, Rob, I thought your high yield pun was pretty clever myself. It took me a minute to figure it out, but yeah, once I did, because I was scratching my head going, high yield, there's nothing high yield in the market right now, but there it is. It's that British humor.
Thank you.
Wonderful. So with that, everybody, welcome. I'm going to go ahead and jump in. And we are going to start with municipal bonds. Very quickly, let me just take a step back. As Rob mentioned, my name is Rod Bettini. I work with Public Trust Advisors. We are a national investment advisory firm, and we focus on local government investment pools and SMA account management. So my particular mandate lies in both Florida and California. As I was mentioning to the team earlier, I have quite the commute here amongst the sales team in the firm. But I spent 10 years of my career building business out in California, and we've recently launched a LGIP out in California class. So I've been spending quite a bit of time out there, and I share my time working here in Florida with Florida Class, which is our Florida-based pool. So just a little background on me and what I do. With that said, we're going to jump right in to investments, and we are going to start with municipal bonds. So what are municipal bonds, or munis as they are more commonly known? They are basically debt obligations that are issued by government entities. As I mentioned, they're commonly known as munis, and it's basically a bond that's issued by a state or a local government, or any entity that states or local governments create, such as a particular authority or a special district. What is the advantage of a municipal bond? Well, mainly, most of them are exempt from federal taxes, and some of them are tax-free at the state and local level as well. So you get a degree, in some instances, of very well-covered tax protection. One of the only real disadvantages, if you will, is that they carry relatively low interest rates compared to other types of securities, but that is, again, given their risk profile. Given their backing, you know, they're safe investments, and they're very important in our economy, because municipal bonds, they help build the infrastructure of our country. So they form a wonderful complement to your investment portfolio, and like I mentioned, you typically in your investment policy have allotted space for municipal bond allocation, and they can be a wonderful vehicle to diversify your holdings and pick up a little bit of yield here and there as we see spreads continue to widen. Now, United States Treasury securities. These are ones we are all familiar with. Treasuries, as they're most commonly known, are issued by the federal government, and they're considered to be among the safest investments you can make globally, because all Treasury securities are backed by the full faith and credit of the United States. In other words, we have the ability to print money, so we are able to collateralize these investments under the implication that we can print more if they're needed to back up our guarantees. So from a global scale, US Treasuries are looked upon as the safest investments there are. And they take several different forms depending on your maturity spectrum. 1 year or less, we call those T-bills. Between 2 and 10 years, those are referred to as Treasury notes. And Treasury bonds, even though a lot of people mistakenly refer to them all as Treasury bonds are actually the longest term maturity structure, Treasuries with 30 years in duration, between 10 and 30 years. The auction schedule goes from 4 weeks to 8 weeks to 13 weeks to 26 and 52 with T-bills. So T-bills don't pay coupon interest. The reason is, much like a zero coupon bond, they're issued at a discount from their face value. And so you buy them at a discount, they accrue value up to par, and that spread between the discount and the par value is what you pick up as your earnings. This is why it's known as a discount security, because it's issued at a discount. This strange looking graphic that ironically looks like a baby bottle's top is a view of Treasury securities outstanding. Here it's showing 22.584 trillion, that's supposed to be. So one point there were $30 trillion in government, in treasury securities outstanding. And that breaks down into different tranches. So this is an incredible amount of money. If you go from left to right, you see the ballooning of these issuances, and it is insane the volume that we're seeing and that we have seen, particularly over the course of the last few years, given the pandemic and all of the monetary and fiscal policy that came as a result of that, right? So we look at this chart and we wonder how, what does all of this represent? Where does all of this money go? We've got a breakdown here of bills, notes, bonds, tips, which are treasury, they're inflation protected treasury securities. But this breaks down into several different groups. Among this figure, intragovernmental holdings represent about 6.5 trillion. These are intergovernmental agencies that buy securities as part of their investment strategy. These are our social security trusts, pensions, so on and so forth. To give you guys a notion of what that looks like, social security trusts held 2.86 trillion in treasuries as of August 2021. The next largest agency was the Military Retirement Fund at 1.03 trillion. But largely the public, which is comprised of not just individual investors, but of all the LPs, your pensions, your large insurance companies, your sovereign funds, and national governments, they hold the overwhelming majority, which as of early this year was a little over $22 trillion. Who do you think, this should have been one of my poll questions, but it's not, so I'll just go over it with you this way. Who do you think is the largest holder of US Treasuries in the world? I know the default answer for many of you is probably China, but that is not the case. Japan is actually the top holder of US Treasury securities in the world. And as of 2021, they were holding $1.32 trillion in US securities. China came in second. They own $1.07 trillion of US debt. And the third largest holder of US debt is the United Kingdom with $579.8 billion. So again, US Treasury securities are looked upon as a global safe haven, not just for US investors, but across the board. Here's a quick little recap. The Treasury market is the most liquid financial market in the world. The largest, buying and selling is very quickly. Investors are drawn to it. Like I mentioned before, they are backed by the full faith and credit. In other words, your investment is guaranteed. That doesn't mean your value is. That depends on your timing, but your principal is guaranteed. Why are treasuries so actively traded? Well, the US dollar is the world's reserve currency. We know that, right? So many private investors have dollars to invest. So it's easy to step into the US Treasury market when you consider the currency denomination and when you consider the safety. Pricing transparency, trading infrastructure, we take for granted our money and capital market infrastructure in this country, but that is one of the things that facilitates global trading. And the amount of international investment that we get is that we have tremendously advanced infrastructure to facilitate these transactions. This is what a sample treasury statement looks like. Just take a minute to look at it. you have, so as you can see, these are T-bills, right? You start on the left, you go right, you have your principal amount. Then under coupon rate, you recall that we mentioned it was discounted. So you have a discount, the maturity, which is when the securities come due, and your effective yield. Pass to Rob for the first poll question.
Thank you, Rod. Let me go ahead and launch this one here, and then I'll read it out. So question number 1 asks, which securities are considered to be risk-free, in quotes? Is it US Treasury bonds, municipal bonds, commercial paper, or Bitcoin? And I'm going to ask people get their answers in pretty quickly here. We've got a lot of content to get through here, so I'm going to try and keep things moving quickly. So last 10-15 seconds, I can see most people have answered. Just a quick reminder, you do not need to get the question correct for credit. You just need to submit an answer to get your CPE credit. So let's keep moving pretty quickly here. Okay, last 5 seconds. Going once, going twice. All right, I'm going to end the poll and share the results. And Rod, you see the results? How did everyone do?
Incredible. No Bitcoin answers, huh?
Good.
I wonder if that would have been different had I asked that question about 3 months ago. Okay, I will move on. US agencies. So agencies is a term used to describe 2 different types of bonds. Bonds issued or guaranteed by US federal government agencies, and bonds issued by GSEs, which are government sponsored and enterprises. These are corporations that are created by Congress for a particular public purpose, such as affordable housing, for instance. So here we are. What I just mentioned, we have our GSEs, which include Fannie Mae, Freddie Mac, and Federal Home Loan Bank. And then we have our US government agencies. So GSE securities, the government-sponsored enterprises, they do not have the direct government backing. There is, however, an implicit, it's like a moral guarantee from the US Treasury to where they, imply that they'll be there if needed from a collateralization standpoint, but it is not a full faith credit guarantee. And therein lies the difference. GSEs borrow in the open market. They issue notes and bonds through these agencies through auction or through a dealer syndicate. And all of this is done very much like Treasury securities under the authority of an act of Congress, which makes them exempt from SEC registration. Here's a little graphic that you can check out, just a side-by-side, so you can get an understanding of the difference. GSEs, as we mentioned, are federally chartered, but privately owned. They're not backed by the full faith credit of the US, but there is that implied guarantee. And here you have some of the examples. Federal Home Loan Mortgage Corp, so Freddie Mac and Fannie Mae. Here is a case back, if you guys recall the housing crisis. This is where the implied government backing comes into place, where the federal government told them, when the housing market completely collapsed, the federal government stepped in and said, we're not going to let Freddie and Fannie default on payment. We will be here to support. On the right side, you have the actual federal government agencies, which are in fact backed by the full faith and credit of the US government. This is an explicit guarantee, and you have the SBA, the FHA. Ginnie Mae is a federal government agency. Let me reply that. Ginnie Mae, let me repeat that rather. Ginnie Mae is a federal government agency, which means that it is backed by the full faith and credit of the US government. So agencies typically yield a little bit more than treasuries. Why? Well, it's not as liquid a market. It's not as big a market. So there's a little bit more in the way of liquidity and availability risk, right? More importantly, it's the risk premium. When you don't have that full guarantee from the federal government, you have to incentivize investors. So how do you do that? You do that through yield. So there is typically a spread between a federal agency and a GSE and a US Treasury. And that spread is what makes up the additional yield premium that is meant to incentivize investors to go with the agency. Now, again, these are quote unquote very safe securities, right? Within the realm of investment options. However, when compared to treasuries, they are slightly less safe. Here's a snapshot of a statement with agency holdings listed. And again, you have the name of the issuer all the way on the left. You have your principal amount, your coupon rate, your maturity, your effective yield, and your value. Give you a second to look at that. Why do we like US agencies? Well, the federal ones are backed by the full faith and credit. GSEs, they're very safe, right? We've already mentioned numerous times, they enjoy the quote unquote implied backing of the US government. So they still fall into a very safe zone. Yield and liquidity, they usually trade at yields offering a positive spread over treasuries. Like I just said, you know, you have to compensate an investor for that additional risk, even if it's slight, even if the security enjoys an implicit backing from the federal government, we want to be rewarded if we're taking risk. There is tremendous amount of bonds issuers available. So as a diversification tool, it's also great. There's an active secondary market for both federal agencies and GSEs, and they're issued constantly, wide range of maturities. So it is a very commonly used instrument, which we see in government portfolios across the country, of course. All right, Rob, I will kick it back to you for poll question number 2.
Perfect. Let me get this one up here quickly. Keep us moving quick. I'm going to launch polling question 2, which asks, which of the following agency securities are backed by the US government? Is it Freddie Mac, Ginnie Mae, Fannie Mae, or Big Mac? So once again, answers in quickly would be very much appreciated. Lots of content to cover here today. We're going to try and get everything in our 2-hour window. So I'm just going to give another, let's say 10 more seconds, please, for these answers to come in. No need to get them correct, but you do need to submit an answer to get your credit. So let's get those in the last few seconds. All right, going once, going twice. Okay, I'm going to end the poll there and share those results. Rod, how did everybody do?
Yes, we got it. I want to give a quick shout out to those folks that answered Big Mac. That's pretty funny. Ginnie Mae is the answer. I tried to emphasize that as we were going through the presentation, but yeah, Ginnie Mae is one of the actual federal agencies, so they do enjoy a full faith credit backing from the US government. All right, let's talk about CDs. What are CDs? So CDs, or certificates of deposit, are basically time deposits, and they're issued by banks for particular terms. The interest reflects small maturity and illiquidity. CDs are insured by the FDIC and the National Credit Union Administration. So the quantities are 250,000 or less. So what is the FDIC? The FDIC is basically a national insurance charter that protects investors in the event of a bank default, because a lot of these CDs are issued by banks. So since 1933, the FDIC seal has symbolized the safety and security of our country's financial institutions. So the deposit insurance provided by the FDIC enables consumers to confidently place their money at across thousands of FDIC insured banks all over the country. And they enjoy the same federal backing and full faith and credit of the United States government through the FDIC charter, however, in quantities of 250K or less. What does and I know we're talking about CDs, just let me digress for 2 seconds on the FDIC. What does the FDIC cover? Because there's confusion about this sometimes. The FDIC covers checking accounts. It covers negotiable orders of withdrawal accounts, savings accounts, money market deposit accounts, CDs, like we're just mentioning, cashier's checks, money orders, and any other official item issued by a bank. What does the FDIC not cover? It doesn't cover stock investments, bond investments, mutual funds, life insurance policies, annuities, municipal securities, T-bills, notes, nothing in the way of quote unquote investment securities, market-driven investment securities that I just named. Why do banks issue CDs? Well, this is how they raise funds, right? This is a way for a bank to build operating capital and do what they need to do on the lending side. Why do we buy CDs? Obviously, safety. They are very low risk, provided you keep to your FDIC insured minimums, which are 250 per issuer, then you're good, because you enjoy the full faith and credit backing of the United States government, right? For me, when I started in this business about 13 or 14 years ago, I was doing a ton of work in California, working with municipalities out there, and CDs to me were a wonderful tool, because not only from a preservation of capital perspective, you knew these funds, we would, depending on the length or the maturity, we would buy a CD for $245,000 to make sure that the interest income that was going to be accrued was also protected by the FDIC, right? Because it's 250 or less. Another attractive component of CDs is obviously yield. It's typically higher than treasuries and agencies of the same maturity structure, but also from a pricing standpoint, CDs, because there isn't this tremendous overabundance of them, the market's slightly less liquid, but they hold their value better. So when you're working with municipalities and their investments are marked to market and valued, and particularly on the bond proceed side, where you cannot go undervalue by too much, we like CDs because they were looked upon as par. I'm talking about new issues, not secondary CDs. So they hold their pricing really well. They're fully protected and they yield well. The only pain about CDs is when you're a municipality that has $20 million. Now you have to go out and find 400 CDs or 40 or whatever that is. It's tedious because the coverage is relatively small when you're looking at it from an institutional lens. Here is a statement that shows you guys what it looks like to hold CDs in your portfolio. You have the issuer on the left, your principal amounts, as you can see, obviously less than 250, your coupon rate, your maturity structure, the effective yield, and then your values. Rob, kick it off to you for our next poll question.
Excellent. Okay, polling question number 3. Let me go ahead and launch it, and then I'll read question 3, which asks, the FDIC will insure up to how much per issued CD? Is it 150,000, 250,000, $1 million, or they no longer insure CDs? So I can see answers coming in nice and quickly here. So thank you everybody for that. Going to give another 15 seconds or so for any remaining answers. Once again, as I've been saying, you do not need to get the answer correct to get CPE credit, just need to submit an answer. So I encourage any remaining stragglers out there to get your answers in, please. Last few seconds. All right, going once, going twice, and I'm going to end the poll there and share the results. Rod, how did they do?
Amazing. Amazing. Great work, everybody. Looks like most folks are paying attention. All right, let's talk about repurchase agreements, or repos, as they are commonly known. So, classified as a money market instrument because of its maturity structure, short-term maturity structure, a repurchase agreement basically functions as a short-term collateralized interest-bearing loan. The buyer acts as a short-term lender and the seller acts as a short-term borrower. And the securities that are being sold, they are in essence the collateral. What's the point of a repo? Well, a repurchase agreement will allow the sale of a security to another party with the promise that it'll be purchased again later at a higher price. The buyer also wants to earn interest. So with a repurchase agreement being a buy and sell back type of loan, the seller acts as the borrower and the buyer acts as the lender. I know that may have come across a little convoluted, but if you look at the graphic here, it's very straightforward. And I'll dumb it down to you like this. I need money right now. Let me borrow some, and tonight I'll pay you back with a little interest. In essence, that's what it is. Here I'm going into a little more detail. As I mentioned, it's basically a form of short-term borrowing for dealers, right? It's typically done overnight, and they get bought back the next day. You have your counterparty, who's going to be your broker or dealer. So for borrowers that are generally banks, repos provide an easy, cheap way to finance their overnight cash needs. That is typically the main functionality. The repo market is hugely important because it allows big institutions to borrow cheaply. The Federal Reserve uses them as a major tool in their monetary policy. These are open market operations, and they temporarily either add or drain reserves, which, as you all know, is a function or a tool of the federal government to help control the economy. They can be deliverable or tri-party. And in a tri-party scenario, the clearing bank is holding the collateral. Okay, so they act almost as a trustee in that particular function. They can be either overnight or term, with the 1 day marking the more liquid markets, and the term are not as liquid, but do, for that liquidity premium, give you a little bit more yield. I don't know if you guys can see the statement to the right there, but that gives you an idea of what repos look like when you're holding them in your portfolio. And here, just as a recap, like I mentioned, repo is basically just a short-term loan. Now, how do we make money? Well, as I've mentioned before, it boils down to our spread, right? The spread, the difference between what you're borrowing or what you're lending at and what is being borrowed at. So the difference between the security's initial price and the repo or repurchase price is the interest paid on the loan, or the spread, and that is known as the repo rate. Let me repeat this, folks. That is known as the repo rate. The difference between the security's initial and repurchase price on the interest paid on the loan is known as the repo rate. As I just mentioned, the Fed uses these a lot in their monetary policy. And like this next bullet says, it is one of our more favored tools to execute our open market operations. And to give you guys an idea of how the Fed controls money supply. So when they're buying securities, when they're buying repos from a seller who agrees to repurchase them, it's injecting reserves into the financial system, right? On the other side, when the Fed is selling securities with an agreement to repurchase, it's draining reserves from the system. I know that's counterintuitive, but if you read closely, you'll see it's basically the exchange. All right, we're back to another poll question, Rob.
Excellent, thank you, Rod. I'm going to launch polling question number 4. This one asks, the difference between the security's initial and repurchase price is it the base price, the repo rate, the repo discount, or the discount basis? So lots of answers coming in pretty quickly on this one. It's a tricky one, but answers are coming in, so I appreciate the speed. Just whilst we're taking the last 10-20 seconds here to answer, I'll mention we've had a couple of raised hands, and unfortunately I'm not able to give you the technology to speak and ask your question live. So if you do have a question, please type that into the Q&A. Maybe the raised hands were hit by accident, but if you do have a question, type it into the Q&A. We've had a couple of really good questions in there, and we've been taking care of those. So yeah, if you have any questions, type them in. But it looks like our answers are pretty much all in here. So I'm going to wrap this polling question up. Going once, going twice, and I'm ending the poll, sharing the results. So Rod, how did they do?
This is a great group, very smart group we have here today, Rob. Excellent, excellent work, everybody. Okay, now let's jump into bankers' acceptances. So basically, bankers' acceptances, or BAs, are negotiable pieces of paper. They function like a post-dated check where a bank guarantees a payment. So a banker's acceptance, it requires the bank to pay the holder a set amount of money on a set date. Most commonly, they're issued 90 days before the date of maturity, but they can mature at any later date, anywhere from 1 to 180 days. Typically, they're issued in multiples of 100,000, and like other securities we discussed earlier, they're issued at a discount to their face value. One of the advantages of BAs is that they do not need to be held until maturity. As I mentioned, they're traded at a discount and from face value, and they trade in the secondary markets where investors and institutions are constantly trading them. What are they typically used for? Well, as we mentioned, a BA is a short-term issuance by a bank that guarantees payment at a later time. So most often, bankers' acceptances are used for importing and exporting, where the importer's bank is guaranteeing payment to the exporter. So it is a tremendously common tool when we're doing global trade. As I mentioned, banks and institutional investors trade BAs on the secondary market before they reach maturity. They're traded at a discount, similar to with zero coupon bonds. They're sold below their face value, and the amount of the discount is tied to the maturity structure, obviously. They are considered to be relatively safe because of the implied collateral structure, where the bank and the borrower are liable for the amount due when the instrument matures. Now we jump into commercial paper. Commercial paper, another very, very common liquidity tool used in our money markets. What is commercial paper? It's a common form of unsecured short-term debt issued by a corporation. It's essentially an unsecured promissory note. Proceeds received from commercial paper are used to finance current transactions, operating expenses, receivables, inventory, this type of thing. You have many issuers, many different maturity structures, but they max out at 270 days. Anything beyond 270 days, now we're dealing in capital markets territory, not money market territory, right? The average maturity, not the longest maturity, but the average maturity for commercial paper is 45 days. So the longer you hold the paper, the higher the yield, the greater the integrity of the issuer, the lower the yield. You have your ratings across the board, just like you do with other securities. And what is something interesting with commercial paper that makes it a more viable tool for issuance purposes is that it is exempt from registration if used to finance current transactions. So it makes it more nimble from an issuer standpoint as far as ways to raise capital. Commercial paper is sold in large chunks. The rate depends on how much the issuer wants to borrow, where money market rates are at, and the credit rating of the issuer. The lower the rating, the higher the yield or rate has to be. Why? Because like we talked about before, you need to compensate investors for their risk premium. If I'm buying commercial paper from some unheard of issuer, God knows where, it better be yielding a lot in order for me to justify my increasing my risk profile. In the municipal space, we tend to stay in the A1 plus world because we don't like to absorb too much risk. But there are issuers across the range, okay? Commercial paper, like T-bills, like BAs, are issued at a discount basis. The buyer pays less than face value, and then you receive the full value at maturity. Who are the biggest institutional investors of commercial paper? Money market mutual funds, right? And your LGIPs and these other large institutional buyers of fixed income, like pension funds, commercial bank trust departments, state and local governments, sovereign wealth funds, and so on and so forth. Massive quantities of CP circulating the market within these LPs. You can fit CP into three categories, right? Non-financial, financial, and asset-backed. Non-financial firms include everything from public utilities to corporate manufacturers. You know, you get the idea here: Coca-Cola, IBM, Toyota, Apple, etc. And then financial firms, banks holding companies, these large financial firms that can afford to sell their CP directly without using a BD as an intermediary, a dealer. It's a cost-effective vehicle in terms of raising capital because it makes for a continuous source of funds. It's low cost and it's very quote unquote easy from an issuance standpoint, okay? You don't have to deal with registration headaches and a bunch of other stuff. Give you an idea of the size of commercial paper markets here. I'll share a couple of key takeaways. Commercial paper, like I said, is a very common form of unsecured short-term debt that's issued by a corporation. What is it used for typically? Financing of payroll, accounts payable, inventories, basically any short-term liability that an issuer wants to tackle. Commercial paper is a good vehicle to do so. This is what a commercial paper holdings would look like on a statement. And here's a another recap. Again, as I've mentioned several times, it's exempt from SEC registration, which makes it an attractive vehicle for capital raising. Non-direct issuers have access to a dealer network, and it's a highly liquid market. Okay, it is extremely safe, again, quote unquote, depending on the rating of the issuer. And it can have different collateral features depending on how you structure it. All right, jumping into the next poll question. Rob, whenever you're ready.
I'm ready, sir. Okay, launching polling question number 5. This one asks, the average maturity of commercial paper is it 270 days, 45 days, 1 to 2 days, or it depends on the rate? So let's give everyone a little bit of time on this one. Still going to try and move pretty quickly. Still got quite a bit of content to cover. I know Rod's got a bit more before we hand it over to the Gatsby guys, but let's give 10 more seconds here. Okay, I'm not seeing many more answers come in, so let's wrap it up. Going once, going twice, and then I'm going to end the poll and share the results. How did they do, Rod?
We are 5 for 5 with this group, Rob.
Good group.
Great work, everybody. Great work. Now, keep in mind, 270 days is the maximum. I'm going to breeze through these slides. As Rob mentioned, we have quite a bit. Asset-backed commercial paper is just a collateralized form of commercial paper. Okay, mutual funds and money market mutual funds. What are mutual funds? What are money market mutual funds? Well, a money market mutual fund is designed to serve as a cash-like position, if you will, for investors' portfolios. They act like cash with a stable NAV or net asset value of $1 per share in most cases, and they can be transferred as quickly as cash, usually the next day. They're not this money market, I just want to make a clear distinction. Money market funds are not the same as money market mutual funds are not the same as money market accounts at a bank. A money market account is just an interest-bearing bank account that you can sign up for. A money market mutual fund is an investment that you hold in a brokerage account at a financial services firm. The distinction between money market accounts and money market mutual funds is important because while money market accounts at banks and credit unions are FDIC insured, your money market mutual fund investments are not. Okay, that is the greatest distinction. So going through this, a no-load money market mutual fund is an authorized investment. And I'm going through here. They are registered and regulated by the SEC. And we don't have to go into all of this convoluted SEC language. I just wanted to share with you guys the basic definition and distinction between the more commonly known money market accounts. So a mutual fund is a device through which investors pool funds to invest in a diversified pool of securities. We know this as a standard mutual fund. A money market mutual fund bears the same structure, but its focus is on liquidity. In addition to the safety that comes with investing in high quality short-term securities, such as US Treasuries and agencies. This is an important point here. By law, the weighted average of a money market fund must be less than 60 days. Okay, this will become a little bit more relevant in a second here. Money funds are mutual funds that invest in short-term liquid assets and pay their investors dividend that reflect these short-term rates. These funds pay daily, invest all deposits in these money market securities, and only keep a sliver of profit margin. Here is a graphic of different money market funds by category. And here is a statement that shows you what it looks like to hold different money market mutual funds in your portfolio. LGIPs, local government investment pools. So in many states, the state treasurer or any authorized governing body oversees pool investment funds that operate like money market accounts for the exclusive benefit of government entities. Unlike mutual funds, LGIPs are typically not registered with the SEC and are exempt from regulatory requirements. So this is very much our wheelhouse at Public Trust. We currently manage 17 local government investment pools across the country. As I mentioned earlier, Florida class in Florida, California class out in California. And this collectively about 55 billion in assets. And this is really our wheelhouse, the local government investment pool structure. Okay, you can have the pools can be created by two different mechanisms, an interlocal government agreement or a trust document. Different states have different investors, and that all depends on different state statutes. What types of funds can you invest in an LGIP? Operating cash, general funds, bond proceeds, state aid. You know, with all of the aid and relief coming out of the COVID pandemic, we were flooded with a tremendous amount of excess liquidity. And we look to our banks. What are they paying us? Are they paying a competitive rate? If not, we have local government investment pool options that can serve to complement your liquidity strategy and hopefully deliver a little bit more in the way of yield than your local bank could potentially be doing. We don't intend these to replace your banking or other liquidity strategies. We look to these as complements of your existing liquidity strategies. You have different types of products within the local government investment pool space. Okay, you have a stable NAV and you have a variable NAV, which are enhanced cash or term products. What is the difference? Well, we talked about this before. Any money market instruments are considered to be 60 days or less in terms of maturity structure. Your enhanced cash or term products are going to be more than that, right? So here, I'm not going to go through each and every one because, like I said, we are a little pressed for time, but I just wanted to share this graphic to give you guys a moment of an A to B comparison between these two tools that are available to you within the local government investment pool space. Ratings. Nationally recognized statistical ratings organizations, or NRSROs, are called credit rating agencies. We know them all. We've heard of them: Moody's, S&P, Fitch. These are the three largest rating structures. And what purpose do they serve? They give us the indication if the securities that we are looking to purchase are safe, and if so, to what degree. We would like to believe that all three ratings organizations are on the same page, but that often isn't the case. So depending on which organizations you work with, you'll get slightly different interpretations. But for the most part, these are excellent indicators of credit quality of particular issuers. When we look at local government investment pool ratings, these are the different ratings offered by the three main ratings organizations to symbolize the highest integrity of pools. So these are all AAA. They just look at it a little bit different given the format of each particular issuer. Okay. With your permission, guys, I'm just going to blaze through this because I know we're down to about 7 minutes and I want to make sure to cover as much of this material as I can. We talked about the LGIP ratings. Regardless of who the issuer is, your AAA is what's going to stand out, whether it's an M from S&P, an MF from Moody's, or an MMF from Fitch's. These are the exact same thing. Extreme capacity to maintain principal stability, strong ability to meet objectives of providing liquidity and preserving capital. Same message, different acronym. With that, let's jump into the next poll question. Rob.
Excellent. Polling question 6. Here we go. This one asks, the following group fund can be invested in a LGIP. Which of the following? Is it bond proceeds, general funds, operating cash, or all of the above? And just whilst we're giving everyone 20 seconds to answer this, obviously, you know, we've said a few times we're moving quickly, a lot of content to cover. If we've moved over something a little quicker than you would prefer, there's always, you can always download those slides and read them afterwards. So I recommend doing that, especially with some of the graphs and visual aids. Those downloading the slides could be handy to refer back to later. So I'm going to give the last 5 seconds here on this question, so please get your answers in. Remember, you do not need to get the question correct. You just need to submit an answer for credit. So going once, going twice. I'm ending the poll there and sharing results. How did they do, Rod?
Correct. We are still operating at 100%. Good work, everybody. And I will continue the presentation. Thank you, Rob. Okay, let's do a quick, we've got about 5 minutes to breeze through an economic outlook. What are we dealing with here? Our main points of discussion. As you all probably know, inflation numbers came in yesterday at a record-setting 9.1. So what does that mean? What is going to happen? So this gives you an idea of, our whole COVID roadmap. Now, when we look at GDP, the components of GDP, the most important issues are consumer spending, investments, net exports, and government spendings. We see this trend here. Here is, when the world shut down because of COVID, then when we all bounced back, and now this is where we are. Consumer spending, that investment, consumer confidence, all of these things we see dwindling down now. We see a 9.1% inflation, consumer confidence numbers at, their lowest. What does this mean? GDP continues a slight rise after seeing this tremendous dip from the COVID effect, our recovery, and now our last numbers here, this is where we sit, and now you see a very mild progression, but we don't know if that's going to be the case, okay? We feel the federal government is setting up to increase rates on July 26th and 27th, another 75 basis points. We're not sure what effect that's going to have on the economy, because as gas prices continue to rise, given what's going on in Russia and the Ukraine, coupled with inflation, coupled with consumer confidence hitting low levels, it doesn't make for a good mix. We see adjusted retail food sales, all of this stuff continuing a decline. I spent some time yesterday and the day before with my friend who was a mortgage broker and another friend who's a real estate agent, and they said for the first time in almost 8 years, they are sitting around. Their business has come to a grinding halt. I know 3 months ago, we were in the midst of this insane real estate market that felt like it would never end, particularly here in Florida. That is not the case right now. Houses are sitting 30 days. Things are changing. A lot of that is driven by consumer sentiment. A lot of that is driven by the economy, but this is the reality. We knew it wasn't sustainable, but we're seeing now the quelling and the slowing down. This gives you guys a visual here of our Federal Reserve target balance and the total assets. It's insane when you look at what's happened over the course of the last couple of years. Here we see percentage rates. This is what the market is pricing in from a rate structure. Now, this is the implied rate here. And this is where we see the number of rate hikes and rate cuts. Now, the market is pricing rate cuts for 2024 already. So while we see this necessity to cool down the economy and to reduce inflation through a more aggressive rate strategy, the market's already thinking that because of what's happening, because of gas prices, because of consumer confidence, the Fed's going to have to pivot back to a cut strategy in 2024. And this is what the market is anticipating. This looks at our overall financial condition and level of financial stress in the US money, bond, and equity markets. And we see what's happening here, right? This is all the pieces coming together. Here is our index of normalized implied volatility on the 1-month treasury options. A lot of this is probably more technical than we need to go into, but we're just trying to illustrate the economy and the current trend. When we look at consumer sentiment, when we look at this, this is what I was talking about earlier, right? Consumer confidence is a massive, massive tool for the federal government to gauge what the economy is doing and what it is poised to do in the future. So when you see these downward trends, when rates are going up, when a $400,000 home that you bought 6 months ago, it was a $2,000 payment a month. Now it's a $3,500 payment. People say, whoa, wait, hold on. Maybe I shouldn't buy this house. Maybe I shouldn't buy this big purchase. And little by little, we see the economy start grinding to a halt. These are our different components of the economy. Very quickly here, with energy, as you guys can see, being the lead indicator. If the Russia-Ukraine thing wasn't happening, would this be more stable? Absolutely. But the reality is, this is where we are. Wage growth, we've seen that happen. Manufacturing, again, we see the downward trend. Labor force participation, we see the unemployment rate has gone down, but the labor force participation rate is finally going up after a long decline. This is what happened during COVID. And now little by little, we're seeing people reintegrate back into the workforce. Here's another jobs chart. Payroll. And with just a couple more slides, guys, I apologize that I'm blazing through these so quickly. I just really want to be respectful of the time of our other presenters. So I don't think we need to go into T-bill curve analysis at the moment. So with that, I will leave you with the next poll question.
Excellent. Thank you, Rod, and I really appreciate you covering all that good stuff. I'm going to launch polling question 7. We've got 2 polling questions back to back here. So 7 and 8 coming back to back. 7 asks, the price difference between an agency yield curve and a treasury yield curve is known as the price basis, the spread, the profit margin, or the goods. So we'll give everyone a few seconds, and whilst everyone's answering, I just want to thank you again, Rod. That was some excellent stuff. I particularly appreciate that, I put you in a difficult spot when I ask you to do a market forecast, an economic forecast or projection. Obviously, I understand no one can read the future, and I think you did a really good job of pointing out some of the data that has come in and some of the data points to keep an eye on. Things like the Russia-Ukraine situation, jobs reports, consumer sentiment, interest rates and inflation. They're all things to keep an eye on as we understand how things are going to move into the future. But yeah, appreciate you taking a shot at identifying those things, because it's impossible to predict the future. So you did a good job of highlighting the important data points. So
thank you. And I apologize at the end for having to crunch that much information into such a short amount of time.
I think you did great. Don't worry. I'm going to wrap up this polling question 7 here and share the results. So Rod, your last thing here, do you want to tell us how did everyone do?
100%, folks. 7 for 7. Great job to everybody. Thank you so much for allowing me to have this time with you all and for, paying attention. You got 100%.
Well, you did well. So I'm going to move on to polling question 8. And this is kind of going to be our transition point. So I'll launch and read polling question 8. And here we're transitioning to the GASB standards. So let me read this one, which is, which GASB standards impact investments and will be discussed during today's presentation? So hopefully people were present for the agenda at the beginning here for polling, to help them with polling question number 8. What you will see in the background here, just whilst you're answering this, is Rod's going to stop sharing his slides, his screen right now, and AJ is going to take over and share the screen for the rest of the presentation. So we'll do that quick transition whilst you're answering the question. So Rod got 100% on his polling questions, AJ. So let's hope you and your questions get the same good results. Last couple of seconds here to answer this question. and then I'm going to turn it over to you, AJ, and you can take us through. So going once, going twice, I'm going to end the poll and share the results. So AJ, how did everybody do?
They got it correct, which I didn't even cover. So that's a step in the right direction. So we'll go ahead and get moving. So I thank you guys for your attention today. So we're going to cover those standards as we talked about: GASB 3, GASB 40, 72, 79. And when we look at GASB 3, much of this has really been superseded, and really it's just providing the guidance for disclosures within the financial institutions and investments, et cetera. So it kind of sets that groundwork for those future GASBs, especially GASB 40. Some of the items in GASB 3 that I just wanted to kind of highlight is really some of the technical requirements and the items that really vary by state statute. So you have in every state, there might be some different requirements about what types of deposits and investments you might be able to invest in, the financial institutions, the collateralization, the liquidity, those types of financial institutions. What banks can you use? Is there a rating on them that needs to be required? Same with the collateralization. A lot of states have a different level of requirement. It might be 50%, might be 100%, might be 102, 110% of those uninsured deposits need to be secured. So you'll have those, you might have some of those requirements. Then the liquidity side as well. The liquidity, you've got this difference between, say, short-term and long-term. And so you might have different funds have requirements that it was more of a cash basis, in your general fund versus something that might have been, for a longer term investment. Okay. And the reasons you might have these different requirements, especially by state statutes for those liquidity purposes, to cover things like payroll. And I have seen, especially in the downturn in 2008, there was a couple of financial institutions, or I should say counties, that had to cash in longer term investments in order to pay their payroll. So now you're taking a large loss as it relates to just being able to cover your everyday bills, which is, not what the general public and the taxpayers are expecting from their trusted institutions. So those are things that you've got to follow what those requirements are in those different states, but GASB 3 lays out what some of those items are. As it relates to what some of the other risks are, really, as you're looking at the risks and safeguards, the deposit risk, the main risk is going to be your credit risk. So are you having some sort of safeguard in there? What's the credit worthiness? Is there a collateral of those financial institutions? Is there an audit of those financial institutions? Really evaluating what that looks like, as opposed to, say, market risk. That's that value decline that, Rod went over. That's not what we're looking at. But from us, we're looking to say, what is the credit risk in GASB 3? Just an auditor tip on this: have a policy, process, procedure to evaluate and minimize those risks, because that should be something that we're looking at as an auditor side to determine what is your requirement. Are you complying with your policies and your standards in order to minimize that risk for the citizens? So the disclosure requirements, as we kind of look at GASB 3, is you've got this legal or contractual provision. All right. So what do you have to disclose? You should be briefly describing in the notes to the financials, what types of investments are authorized by legal or contractual provisions. Okay. So what items are in there? For example, if you've got collateral that's held by a third party, but is it in the right institution? Okay. So maybe that's a significant violation. So if you've got collateral, but it has to be their third party, what if it's not held by the third party? Okay, so you've got to include what are those requirements within there. Same thing with the deposits and investments and the balances, those balance sheet dates during the period. So what is the amount at the end? What amount is collateralized, et cetera? Any sort of other repurchase agreements, the reverse repurchase agreements, you've got to disclose that information, the balance sheet dates, and any sort of those provisions that are in there. So basically, what are you investing in and what are their balances? Lastly, in GASB 3, before we really kind of move forward into the more current items, is when you look at your disclosure requirements, this item here in GASB 3 was really superseded. In GASB 3, there was a lot of, you had to disclose it as the entity as a whole, as well as some other separate disclosures for the component units, pension trust funds, kind of within the opinion units. There were some actual consolidation in GASB 40 as well, but we're going to talk more about those in a moment. So I'll let Rob go ahead and do a poll question.
Okay, here goes polling question number 9, launching that. And this one asks, GASB 3 describes which of the following risks? Is it credit risk, market risk, fraud risk, or both A and B, or all of the above? So let's give everyone, answers are coming in quite quickly. So I'm going to give everyone about 15 seconds. I know we're moving quickly here, but as I've said, just need to get an answer in for credit. Does not need to be correct. So let's get these answers in, please. Okay, last few seconds. Right, going once, going twice. Now I'm ending the poll and sharing the results. AJ, how did everyone do?
Correct on the both A and B. Fraud risk is not something that GASB is going to cover on that one. So excellent. So as we move into GASB 40, which is really much more, it's an amendment of GASB 3, and it talks about those deposit and investment items. That item that we had talked about in GASB 3 really was superseded by this statement. It talks about that level of detail. And so here we really kind of break out that it must be presented for the primary government, the blended component units, the fiduciary types, non-major funds, major funds. So you're really looking to say, okay, what are the primary government's total investments, and how do you break these out by the different areas where they might be? You might have some capital project funds, has all the investments in one issuer of bonds, and you might have to disclose what that concentration is. And so you've got to make sure by the opinion units, much more, not necessarily, in that detail are in there, as well as then you have this increase of the level and some changes of the levels you're really relating to those credit risk disclosures that need to be disclosed as part of GASB 40, and it tweaked some of the language there. So as we really look into what those policies and the procedures are, you need to disclose those. So as we talked about with GASB 3, you should just briefly describe the deposit investment policies that are related, and the risk of the statements need to be disclosed. So again, if the government has an exposure to a concentration of credit risk, that policy disclosure regarding the credit risk is required. So what is that policy that you have? Which items are subject to it? Is it? And then disclosing those different assets. Okay. When we look at the specific risks as we relate to, say, credit risk, which again, that was what we were looking for, which one of those large risks that we have on those deposits. The credit quality ratings you would want to disclose. So you'd have to disclose all those rating agencies and all those, the credit ratings that Rod had gone over. You're going to disclose something from the nationally recognized organizations of what the credit ratings are in those debt securities. Unless there's information to the contrary, U.S. government securities, U.S. government obligations, they're guaranteed by the government and are not considered that credit risk, as he said. So you don't have to disclose those as part of that credit rating, but you do need to disclose credit ratings for other items. So credit rates of external investment pools, money market funds, bond mutual funds, or other pooled investments. And then if you don't have a credit quality disclosure, if a credit quality disclosure is required and the investment is unrated, you have to disclose that as well. So if you can't get what that rating is because it's not rated by an agency or for whatever reason, that would need to be disclosed. Okay. For the custodial credit risk, so this was part of the updates that you have. Deposits are exposed to custodial credit risk if they are not covered by depository insurance and the deposits are uncollateralized, collateralized with securities held in pledging institution by pledging the financial institution, or collateralized with security held by the financial institution's trust department or an agent, but not in the government's name. So anything that's exposed to some sort of risk, you need to outside of the insurance, you have to disclose what that risk is for that credit, and what items have been backed to secure that, just in case in the event of a bank failure or anything like that, to be able to provide that comfort to the citizens. In addition, if the government has deposits at the end of the period that are exposed to the custodial credit risk, you need to disclose the amounts of those balances, the balances that are uninsured, and whether the balances are exposed on the basis of A, B, and C above. So if you have a bunch that's insured, but then you have some uncollateralized items, call it $10 million, and then you've got $5 million that is secured by a third-party trust, Now you've got 5 million that's still exposed. So you have to disclose all of those items in relation to those custodial credit risk items for the government itself. From an investment side, you also have to disclose the custodial credit risk. So if you've got an exposure from an investment, not necessarily your deposits, you would need to disclose that as well. So what is the amount that's not registered in the name of the government, that's held by the counterparty or by the counterparty's trust department? And Rod had covered all the counterparty definitions, so we're not going to spend much time there. From a custodial credit risk perspective, you need to be disclosing anything that has, if the government's got investment securities at the end of the period that are exposed to custodial credit risk, it should disclose the amount, the type, and how they're held. So if you have a substantial amount of, you want to just give all of that information to the users. Okay, so there are some items that are going to be considered exempt from those, such as open-ended mutual funds are not exposed to credit risk because their existence is not evidenced by the securities, but you need to be disclosing what is exposed, what's the amount, and how those investments are held. On the concentration of credit risk, okay, so we talked briefly about this at the beginning as an example of the policy itself, but you need to be providing information about the concentration of credit risk with investments, again, by disclosing the amounts, the issuer, and the investments of any one issuer that represents 5% or more of total investments. So anything that's going to have this in excess of 5% of your totals, you might put a chart in there. It might just be one or two items. But if there's some issuer that is in excess of that 5% threshold, you're going to have to disclose all of that information. Now, there are items that are exempt from that, items that are explicitly guaranteed by the US government, investments in mutual funds, external investment pools, and other pooled investments are excluded from that. So know that those are the exclusions, but if you've got some sort of other investment that's going to sit there in excess of 5%, you do have to disclose what that looks like. Another item, lastly, before I turn it over to Dean to get his commentary truly on GASB 40, is going to be related to your interest rate risks. So as another risk to the government is if you lock up your funds for a long period of time, that's your interest rate risk. So you have to disclose the information about that risk of the debt investments, and then also disclosing the terms of those investments. And it would be with some sort of fair value that's highly sensitive to the change in interest rate. So there's different areas of which you could follow. There's a segmented time distribution, the specific identification, weighted average maturity, your duration, or your simulation model. And so all of those are actually explained in GASB 40 about what those different requirements are and how you kind of organize those investments. But I just at least wanted to comment on them, and then I'll turn it over to Dean for his perspective from the GASB.
Thank you, AJ. And just following up on what you just said, with respect to the disclosures on interest rate risk, what Statement 40 is asking you to do is to pick the appropriate kind of disclosure for interest rate risk based upon the way that you manage that interest rate risk. So if you manage it based upon measuring duration, for instance, or weighted average maturity, then that's the way you ought to disclose your exposure to interest rate risk, because that's the way that you measure it, and that's relevant to the financial statement users. There are a few other things about Statement 40 and Statement 3 before it that I think are worth mentioning that maybe not a lot of people know. The risk disclosures that Statement 40 requires are emblematic of one of the primary interests of financial statement users, which is the possibility that a government will lose resources that are needed to finance the things that they're particularly interested in, such as making debt service payments or reducing taxes or expanding programs and so on. The financial statement users also want to know what a government is doing to manage the risks it is exposed to, which is why, as AJ said, Statement 40 requires the disclosure of deposit and investment policies. A government's policies for managing investment risk are so important to financial statement users that Statement 40 contains one of the rare instances of the GASB requiring a negative disclosure, which it almost never does. And AJ touched upon this. If a government doesn't have a policy for managing a risk it is exposed to, it is required to disclose that it has no policy. And then lastly, Statement 40 is also noticeable for having reduced the disclosure burden related to cash deposits. Previously under Statement 3, all cash deposits had to be disclosed and disaggregated based upon the level of custodial credit risk that they were exposed to. And Statement 40 greatly simplified that disclosure to focus only on the deposits that face the greatest custodial credit risk, which is those that lack insurance and lack appropriate collateralization. I think the next slide is a polling question, right?
Yeah, thank you, Dean. So we'll go ahead and get to polling question number 10. We'll turn it over to Rob.
Okay, here goes polling question 10, launching that one. And this one asks, deposits are exposed to custodial credit risk if they are not covered by depository insurance and the deposits are uncollateralized, collateralized with securities held by pledging, by the pledging financial institution, collateralized with securities held by the pledging financial institution's trust department or agent, but not in the depositor's government's name, or any of the above, not all of the above, but any one of the above. So that was a tough one for me to read out. So hopefully it's not so tough for everyone to answer. But yeah, if you're listening closely, you'll have seen this information on one of the previous slides. So I'm going to give everyone another 15 seconds because this is a tricky one and a lot of reading there. So I'll give it a little bit longer here. All right, I can see the last few answers seem to be coming in. We're getting pretty close to fully complete. So last couple of seconds to get your answers in. So going once, going twice. I'm ending the poll and sharing the results. AJ, how did everyone do?
Any of the above is correct. So therefore, I think all 4 answers are correct. So, but yes, any of the above is the correct answer. We did cover that. Okay, now we will jump into GASB 72. So fair value measurement and applications. So this one was one that I think it was a pretty significant standard just from a disclosure perspective. It kind of added a little bit of burden really from the work perspective, changed some items within the disclosures, and then really kind of gave some of that information of what it was trying to do. So basically GASB 72, the objective that they put out was, what I look at it is pretty quickly is, what is it? How do we obtain the fair value? And what do we do for disclosures? Because that was their objective. Clarify the definition of fair value, establish general purposes for measuring fair value, provide additional application guidance, and then enhancing the disclosures about fair value measurement. So that's what we kind of look at. We're going to kind of cover these in brief detail over the next few minutes. So the definition of fair value, what the GASB defined it as, is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So basically, how much, right? So that's kind of the technical definition of how much does it cost. The measurement date is the date at which the fair value or the liability is determined. So for financial reporting purposes, it's typically year end, the balance sheet date, the statement of net position date. Now, of course, at any other point, you're determining fair value, for your regular operations. But from an auditor and an accountant, as a general historian, we're looking in the past, and that's what that definition is going to talk about. The other part is that they also determine that fair value is the exit price at the measurement date from the perspective of a market participant that controls the asset or is obligated for liability. So that exit price, that's the price that would be received to sell the asset or paid to transfer it. So this is really I would almost call it your consideration, the cash that you're going to get back. Okay. So when we look at, that's what the idea was. Now, when we look at the valuation techniques, we're going to really utilize the valuation techniques that are appropriate in the circumstances. And what those are is going to be, we want to maximize the use of relevant observable inputs and minimize the use of unobservable inputs. So when you're talking about something that's observable, it's developed using market data, and unobservable is inputs for which market data is not available. So, how do you really look at that? You want to try to have the best, most active market that's going to help you maximize the reliability of that pricing strategy. Okay. The other valuations, the other part we'll look at is you're going to use the valuation techniques with one that's consistent with one or more of the different approaches, the market approach, the cost approach, and the income approach. So we'll kind of cover what those are briefly. So when we talk about the market approach, we're going to use these prices that other relevant information that's generated by market transactions involving identical or similar items. So quoted market prices. So this is kind of what I think of is you're going to basically take in an active market, you're going to have a transaction that takes place with sufficient frequency and volume to give you information for an identical asset or liability. So I always kind of think of this as Yahoo Finance, right? Like, Yahoo Finance, I need to know this day. This is what I'm looking up. So you know exactly what that's looking at. That's that quoted market price. You've got these market multiples, which is some different ratios that you might be a price to earning or market to book value, that you're going to be looking at these different similar assets, identical or similar assets, liabilities, groups of assets. And you might have a little bit of variation in some of those items, but you're looking to kind of determine what is acceptable range of these assets and liabilities might be. Or you have a matrix pricing technique, which is, be principally to value some type of financial instrument, such like a debt security, without relying exclusively on quoted prices. So it's going to rely a lot on the security. That relies on the securities relationship to other benchmarks as well. So those are kind of your market approach that's going to be utilizing those pieces. The cost approach, as you relate to valuation, is it reflects the amount to replace that present service capacity. When we're talking about present service capacity, that's replacement cost. The other is maybe like an income approach, where you're going to be looking to say what's to convert future amounts to a single current amount. Your discounted present values. You might have a present value item, an option pricing model, which is really going to be the technique to value an option contract based on those, the critical terms or the contract with some implied volatility. Or then you've got this multiple period excess earnings, which might be, say, it's associated with the prospective financial information. That's another type of valuation technique. So when we really get into this fair value hierarchy is another portion that's related in there. So level ones, level twos, and level threes. And I know Dean will go over what a lot of this information is, but the level ones are going to be your quoted prices, unadjusted, active markets, identical assets. I kind of, again, I think of it as identical and active. That's level one. Pretty easy to find. You can find the measurement date. You can find that information that they're available. Okay. Level two is inputs other than quoted prices included within the level one that are observable for an asset or a liability. So it's going to be for a similar asset or liability in an active market. Okay. Or it might be quoted price for an identical or a similar asset in a market that's not active. Those are kind of what we're looking at level twos. And level threes are unobservable inputs for an asset or liability. So as I kind of break it down from all of the technical language, I kind of look at level ones, pretty simple. There's of course some nuance, but as level ones primarily is identical and active. I think of level twos as similar or not active. And level threes I think of as kind of off the wall. You just don't know exactly what's the same thing. It's hard to value. And so we're trying to minimize that as much as possible and disclose those. So once you've kind of gone through those pricing strategies and that fair value measurement, we have to really have these disclosure requirements. So we have to disclose per 72, there's recurring and non-recurring fair value measurements. And so I like to kind of define what that means. The recurring fair value measurement is going to really relate to the measurement that's required at the end of each reporting period. A non-recurring measurement, it's more driven by a particular event or transaction. And so you have to disclose For recurring and non-recurring, you have to disclose a fair value measurement at the end of the reporting period. So what is that measurement at that date? What is that fair value hierarchy? Are they level 1s? Are they level 2s? Are they level 3s? And you have to describe what that valuation technique was used in the fair value. So did you use the market approach? Was it the cost approach? And how you got to those pieces of information? In addition, you would need to be able to disclose if there's been a change in the valuation technique that's going to have a significant impact on the result. So if you've had some sort of change, you're going to have to put that in there. And then an additional one is for the non-recurring fair value measurement, you have to disclose the reasons for that measurement. Okay, so that's an additional piece as it relates to the fair value. So for that, I'm going to turn it over to Dean for his perspective.
Thank you, AJ. There are a couple of things that I think are very interesting about Statement 72. One is that significant portions of Statement 72, particularly those that are related to how fair value is measured, are largely identical to what you would see in what originally was FASB Statement 157. When the GASB board, looked at how fair value is measured, its conclusion was it doesn't matter who you are, whether you're a government or a corporation, fair value is fair value. On the other hand, the guidance on the application of fair value in terms of what assets or liabilities should be reported at fair value differs quite a bit from what the FASB requires. And the required disclosures in Statement 72 for governments are substantially less burdensome than those of the FASB. So AJ started off by mentioning that these did add some, Statement 72 did add some degree of burden in terms of disclosure, and that's undeniable. But if you compare it to what the FASB requires its entities to disclose with respect to fair value, the burden is considerably less. The second thing I'd mention is that the disclosure is specifically required for alternative investments, which the statement eloquently calls, in a way only GASB can phrase it, investments in certain entities that calculate net asset value per share or its equivalent, reflect financial statement user concerns about investment risk with respect to those investments. Alternative investments are opaque at best from the perspective of the financial statement user, which makes it difficult for them to assess the degree of risk that those investments expose a government to. So the additional disclosure that's required for those investments is necessary to increase transparency from the perspective of the financial statement user. In other words, these standards are not expressing any opposition to alternative investments or trying to penalize governments for getting into them by increasing the related disclosure burden. Rather, the additional disclosures reflect the greater risk that they expose the government to. And I think generally you can see a relationship between the level of risk that a government's exposed to and the level of disclosure it's expected to make. And then lastly, I think many governments and other people involved in applying Statement 72 were surprised to discover that the fair values of U.S. Treasuries and similarly risk-free or low-risk investments were not automatically considered to be based on level 1 inputs. In practice, the prices you see quoted on those investments generally are based on the most recently issued series of those investments, which are referred to as being on the run. And then once such investments are no longer on the run, in other words, after the next series of those investments are issued and are being traded, they become off the run. And then their fair values tend to be based on level 2 inputs rather than level 1. And I think that reveals that the level of inputs to fair value relates to the transparency of the fair value measurements, as AJ was describing, and the ability of people outside of a government to independently verify them, and not to the level of risk that's inherent in the investment, although there may be some correlation between the opacity of an investment's measurement and its riskiness, but that's not what determines the level of input into the fair value measurement. So, Rob, there's another polling question now.
Thank you very much. Okay, let's get into the next one here. Polling question 11, I am launching now. And this one asks, an investment which is valued based on unobservable inputs should be classified in the fair value hierarchy as a level 1, level 2, level 3, or none of the above. It should be reported at amortized cost. So I'll give everyone a few moments here. We are on the home stretch, everyone. So we've got the last 5-10 minutes at the most before we finish up. So try and hang with us, please. That would be much appreciated. I'm going to just give everyone a few moments here to wrap up this last question, and then we'll move on to our last GASB standard. I'm seeing most of the answers are in, so I'm going to just do 5-6 seconds left here. So I'll quickly get your answer in for your credit. Okay, going once, going twice, and I'm ending the poll and sharing the results. So AJ, how did everyone do?
Excellent. Level 3 is correct. Those are those, as I call them, the who knows, the off the wall, right? The unobservable inputs. So I don't mention it as eloquently as Dean, but I really appreciate the commentary on that. So thank you all. And lastly, we're going to cover statement 79. This is really just going to talk about some external investment pools, you know, those what we were talking about, I know public trust and those net asset pools, a lot of those treasury pools that we talk about. So the scope itself is they really wanted to, after 72, they needed to establish some accounting and financial reporting standards for the qualifying investment pool. So then they actually kind of said, what is the requirement to make sure that it is a qualifying pool? So we've got some definitions of what, you know, some things to look out for. Okay, so they wanted to put in this information as it relates to this amortized cost, right? Because you're not necessarily getting these net asset value, or this not asset value, but the fair values every single at the end of the period. They'll do them periodically, but they kind of just do this amortized cost allocations. So when we look at what the external investment pool, it may elect to measure all of its investment at amortized cost if it meets the following criteria. So there are criteria that are set out in that. So part of it is the transactions that would participate at a stable net asset value. So for example, all the contributions and redemptions and transactions are at $1 asset value per share. It's got to meet portfolio maturity requirements. So some examples of that, it's not an all-encompassing list, but some examples of the portfolio maturity: security remaining of 397 calendar days or less. The weighted average maturity has to be 60 days or less. Rod talked a lot about the commercial paper and those different areas of the weighted average maturities, et cetera. And there's some reasons for those. Obviously, we talk about 79. Weighted average left of 120 days or less. So those are some portfolio maturity requirements. There's also some as it relates to the quality requirements, diversification, liquidity, and then meeting these shadow pricing. And so from a portfolio quality requirements, are they rated by an agency? Are they in US dollars? There's could be a limitation on the portfolio of non-rated or lower rated items. So you may limit the amount of items that you put in there that aren't rated. It shouldn't be exposed to custodial credit risk. What's the collateralization as we talk about those from a quality perspective? When you meet the diversification requirements, it can't have no more of 5 or 10% of any one issuer. There's some requirements of what is 5 and what is 10% within the standards. The liquidity requirements, it's got to hold liquid assets sufficient to meet the reasonable foreseeable redemptions, no more than 5% in illiquid investments, at least 10% in daily liquid investments. And then the shadow pricing is basically the shadow price of the net asset value per share for qualified and external investment pool calculated using the investments at fair value of the calculation date. And so you've got to at least monthly minimum and not deviate from more than 0.5%. So there are some requirements as it relates to those. If you meet that, then net asset amortized cost is acceptable. Okay. And if there's an investment pool that is significantly not compliant with the above criteria during the reporting period, it generally should not measure the financial reporting purposes, all of its investments and amortized costs for that reporting period. So if it doesn't meet those criteria, you have to fair value that investment. So I'm going to turn it over to Dean for his comments.
Thank you, AJ. There are two observations I'd like to make on this topic. The first is that GASB was prompted to rein in these so-called 2A7-like investment pools in Statement 59, because in practice, some of those pools were no longer in conformity with the provisions of SEC Rule 2A7, as you were describing them, AJ. So Statement 59 had to make this clarification that there's no looseness intended by the use of the word like in 2A7 like. It's not in the neighborhood of 2A7. That what it meant was that those pools should be like any other 2A7 pool, with the exception that because they're governmental entities, they're not required to register with the SEC. They don't have to file reports with the SEC. Statement 79, on the other hand, was almost purely a lifeline to those government investment pools and their participating governments, because the SEC was in the process of revamping Rule 2A7 and pretty significantly upping the requirements to qualify as a 2A7 pool. So what Statement 79 does in essence is disconnect the rules for using qualifying to use amortized cost as an external investment pool from Rule 2A7, and more or less retaining the existing criteria plus some of the new criteria that the SEC was developing that are relevant to government-run investment pools, but essentially taking it into the GASB's hands now to maintain those rather than exposing those pools and their participants to the possibility of losing that 2A7-like status that they had before, because they wouldn't be able to meet some of the criteria that the SEC has since established for those money market funds, some of which would have been a much higher hurdle to clear, and some of which, particularly with respect to governance, don't particularly translate well into the government environment. And those are my comments on Statement 79.
Well, perfect. Well, thank you, Dean. We will go into our last poll question then.
Okay, here it comes.
Leonard?
Polling question 12. I'll launch this one. This one asks, external investment pools may elect to measure all of its investments at amortized cost if it meets which of the following criteria? Transactions with participants are at a stable net asset value, meets portfolio maturity requirements, and meets portfolio diversification requirements, or is it all of the above? So just whilst everyone's answering there, I'll do a quick thank you to all of the presenters today and everyone for joining us as well and watching today. Particular thanks to Dean. He actually only joined CRI this week. So at very short notice, he's jumped in and added some really, unique perspectives with his 24 years of GASB experience with working with the GASB. So I really appreciate him coming in at short notice, and being able to do that so quickly just shows just how much depth of knowledge he has and what an excellent resource he is. So supremely pleased to have him on the CRI team now. And at the end, we'll give out everyone's email addresses. And if anyone has GASB specific technical questions that they want to put to Dean, feel free to email those to him. Like I say, he's now a resource that CRI has, and we're very pleased to have on board. So, but yeah, thank you all the presenters. Great job today. I'm going to wrap this up here on this final polling question in just maybe 5 seconds, because most of the questions answers are in. So going once, going twice. Last poll question of the day is ended. And I'm sharing the results. AJ, what do you think about the results?
All of the above is correct. So we went with a perfect 12 for 12. So that's Hall of Fame numbers. I mean, Tony Gwynn's got a lifetime batting average of 338. So he only needed to get 4 right. He's still in the Hall of Fame. So we all outdid Tony Gwynn today.
Well done. Big baseball fan that you are, AJ. I should have known there'd be a baseball reference sooner or later, but yeah, that's excellent, everyone. I've just checked. We have cleared all of the Q&As directly in that Q&A chat panel, so we can scroll through these last few slides, get to those email addresses. Obviously, like I say, we've dealt with all the polling questions. We always recommend people follow CRI on their social media platforms, or just keep an eye on our website, cricpa.com. We do regular CPE sessions that are specific to governments. I know you're going to be hearing from Dean a lot in those sessions in the future, so I'm sure everyone will look forward to that. And like I said, there's those email addresses, in particular, Dean's for GASB specific questions, Rod there for investment specific questions for public trust advisors. But that's all we have for today. I appreciate everyone for listening, and I hope you enjoyed the session, and thank you all. So have a good day, everyone. Goodbye.